Imagine living in Argentina today, where your currency loses value between sunrise and sunset. Prices shift so fast that people rush to spend their paychecks immediately, not out of impulse, but out of survival, because waiting even a single day means your money buys less. Or imagine living in Lebanon during the 2019 financial collapse, when banks suddenly froze withdrawals nationwide. Families couldn't access the savings they'd spent decades working for. For some, the only option left was storming banks in desperation just to get their own money back. Or picture China in 2022, when several rural banks froze the accounts of thousands of depositors overnight. Not because of criminal activity, but because the system itself failed. Or consider the experience of millions of people in Nigeria, India, and the Philippines who simply want to send money to relatives abroad, but find themselves paying double-digit fees and waiting days for the transfer to clear. None of these are conspiracy theories. None of them are speculative. They are real, documented events from the last decade. And collectively, they reveal something uncomfortable. The global financial system doesn't work equally for everyone. And in many places, it doesn't work at all. In the middle of these cracks, vulnerabilities, and institutional failures, a new technology rose into public consciousness. A technology designed not to make people rich, not to fuel hype cycles, and not to spark endless debates online, but to solve deep economic problems that the traditional system had no answer for: crypto. Today, we're unpacking the hidden economics of crypto, why it exists, what problems it was designed to solve, and why, despite every crash, every scandal, every regulatory battle, it continues to survive. Crypto is one of the most polarizing ideas on Earth. Some swear it's the future. Some swear it's a scam. Most aren't sure what to believe. But underneath the market bubbles, the memes, the speculation, the maximalists, and the skeptics, there's a deeper, quieter story. An economic story. Crypto didn't appear out of nowhere. It wasn't born in Silicon Valley. It wasn't created by a government or a corporation or a billionaire. It emerged from a breakdown in trust, a failure in the global monetary system, and the economic need for an alternative that didn't rely on the institutions people felt had betrayed them. Once you understand the 7 hidden forces that shaped crypto's emergence, you'll see why it exists and why it keeps resurfacing, even when people assume it's dead. Let's decode it. Hidden force. Number 1, the trust collapse problem. Most people believe money runs on numbers, but it doesn't. Money runs on trust. You trust your bank to hold your savings. You trust your government not to inflate away your currency. You trust payment systems to work when you need them. You trust the financial infrastructure behind society to keep functioning. But in 2008, that trust collapsed. Banks failed across the United States. British and European institutions needed emergency bailouts. Iceland's banking system imploded entirely. Greece spiraled into sovereign debt crisis. Cyprus froze accounts and seized part of people's deposits. Globally, people watched institutions they trusted reveal themselves as fragile, mismanaged, and deeply interconnected in ways no one understood until it broke. The world discovered a harsh truth. Banks don't store your money, they store your permission, and permission can be revoked. Right in the middle of this chaos, on October the 31st, 2008, a 9-page document was posted to a small cryptography mailing list. The Bitcoin white paper, written by the pseudonymous Satoshi Nakamoto. And the very first sentence delivers the thesis in one clean line. A purely peer-to-peer version of electronic cash would allow online payments to be sent directly from one party to another without going through a financial institution. Bitcoin wasn't created as a get-rich-quick scheme. It wasn't created for trading. It wasn't created for speculation. It was created to solve institutional trust failure. It offered money that didn't require a bank. Money that couldn't be frozen. Money that couldn't be seized. Money that had a predictable supply. Money that removed permission from the equation. It was an attempt to create a monetary system where trust didn't have to be given, because trust wasn't required in the first place. This isn't a political idea, it's an economic one. When trust becomes expensive, societies begin looking for trustless alternatives. Crypto exists because trust broke. And if you're watching from a country that's experienced inflation, capital controls, banking freezes, or economic instability, share your perspective in the comments. Crypto's role looks completely different depending on where you live. Hidden force number 2, the double spending breakthrough. Most people think Bitcoin's innovation was digital money, but digital money already existed in online banking, debit cards, PayPal, and every payment platform on Earth. The real breakthrough was solving a 40-year economic and computer science problem. How do you create digital money that can't be copied? If money is just data, what prevents someone from duplicating it like a photo or a PDF? This is the double spending problem, and before 2008, the only solution was centralized control. Someone, a bank, a clearinghouse, a company, had to maintain the ledger and enforce the rules. Satoshi introduced something revolutionary, a decentralized ledger called the blockchain, a shared record of transactions, visible to everyone, owned by no one, secured by economic incentives rather than institutional authority. This created something that had never existed before. Digital scarcity, money that behaves like gold, not like software. It also enabled final settlement without needing a bank to approve the transaction. It produced consensus without a ruler, where the network, not a person or institution, decides what's valid. And it introduced security through incentives, where people who maintain the system are rewarded for doing so honestly. This wasn't just a technological breakthrough, it was an economic one. Crypto exists because someone finally solved the core problem required to create decentralized digital money. And once solved, everything else became possible. Hidden force number 3, the invisible inflation tax. Inflation feels like a rise in prices, but economically, it's a silent transfer of wealth. When governments print money, they're not physically taking cash from your wallet, but they are reducing the purchasing power of the money you hold. Your balance stays the same. What it can buy erodes. This is why economists call inflation a hidden tax. It transfers value from savers to the issuer of the currency. Periods of money printing after the 2008 crisis, after the 2020 pandemic, and throughout various emerging market crises, created fertile ground for crypto's narrative. Bitcoin positioned itself as digital gold, a scarce asset that couldn't be inflated. And while the comparison isn't perfect, the psychology is powerful. Gold has historically risen when trust in currency falls. Bitcoin was engineered to behave similarly, but with programmable, transparent scarcity. There's an old economic principle called Gresham's Law, which says that when people have good money and bad money, they spend the bad and save the good. In economies like Argentina, Turkey, Venezuela, and Zimbabwe, places where inflation is not an annoyance but a threat, Bitcoin became the good money people held on to when their national currency couldn't be trusted. Crypto exists because inflation pushes people toward alternatives that can't be diluted by policy or political decision making. And it exists because people intuitively understand a simple truth. Scarcity holds value. If this is making the world make a bit more sense, hit subscribe. Hidden Economics is all about giving you the clarity most people never get taught. Hidden force number 4, the friction cost of the banking system. Here's a simple question. Why does your money move slower than your email? It's not a technology problem. Banking systems have access to fast digital communication. It's an economic problem. Traditional finance is built on layers of intermediaries: banks, payment processors, compliance checks, clearing networks, correspondent banks. Each one adds cost, delay, and restrictions. If you've ever sent a wire transfer internationally, you know the feeling. Waiting days, paying fees, and hoping nothing goes wrong. For billions of people, banking friction isn't an inconvenience. It's a barrier. Remittances can cost more than 10%. Foreign currency rules restrict what you can buy. Bank accounts require documentation many people don't have. Cross-border transfers get flagged and delayed. And in some parts of the world, millions are excluded entirely from the system. Crypto attacks these friction points directly. It moves value globally, 24 hours a day, without borders, bank hours, or intermediary approval. Settlement can be almost instant. Access is as simple as downloading an app. And participation isn't limited by geography or identification barriers. One of the most important developments in crypto isn't Bitcoin. It's stablecoins. Digital dollars that people in unstable economies can access when their own currency fails them. In many places, stablecoins aren't a speculative asset, they are a lifeline. Crypto exists because moving money with the speed and openness of the internet should not be expensive, slow, or exclusive. Hidden force. Number 5. The incentive layer, a new economic engine. Traditional networks grow in a very predictable way. A company builds a product, then spends money to attract users, and eventually extracts value from the network it built. Crypto flipped this model entirely. There is no company, no CEO, no central marketing team, no single owner. So how do you grow a global network without those things? Crypto's answer is simple. Reward the people who run the system. Miners secure Bitcoin and earn Bitcoin. Validators secure Ethereum and earn yield. Liquidity providers enable markets and earn fees. This incentive design transformed crypto from a technology into an economy. Users weren't just participants, they were owners, and ownership created alignment. People who secured the network wanted it to succeed because the value of what they earned increased as adoption grew. Speculation wasn't a mistake, it was the mechanism that bootstrapped decentralized infrastructure. Economists call this the network effect. The value of a network rises as more people join it. Crypto built financial rewards into the network effect itself. This is why decentralized systems reach global scale without needing a corporation behind them. Crypto exists because it solved the economic question of how to build and maintain global infrastructure without central ownership. Hidden force number 6. The platform without a company. Problem. There's a structural limitation in the design of the internet. Global platforms require global owners. Before crypto, everything depended on a company, whether it was social media, payments, or cloud services. And companies come with vulnerabilities. They can be censored, seized, hacked, sued, corrupted, or shut down. Crypto introduced a new category of platforms without companies. Bitcoin isn't a corporation. Ethereum isn't headquartered anywhere. DAOs don't have CEOs. Protocols don't have boardrooms. They operate like digital infrastructure. Neutral, open, and resilient. This solved a long-standing problem. How do you build a globally accessible financial system that no single entity can control or co-opt? Crypto's answer was decentralization. Not as a slogan, but as an economic governance structure. It's why regulators struggle with crypto. They're equipped to regulate companies, but a decentralized protocol is not a company. It doesn't have executives, it doesn't have a location, it doesn't have a door you can knock on. Crypto exists because the world needed infrastructure that is ownerless, borderless, and permissionless. The same way email became the infrastructure of communication. Hidden force. Number 7, the permission problem, the real why. Now, we arrive at the deepest reason crypto exists. It solves the permission problem. In the traditional financial system, your account can be frozen. Your transaction can be blocked. Your access can be denied. Your funds can be delayed. Your transfers can be questioned. Your financial life can be interrupted without warning. Even if this rarely happens where you live, the power imbalance still exists. Someone else ultimately controls your access to your own money. Crypto flips that dynamic. You hold your own keys, you control your own funds. Transactions go through without approval. Your account can't be turned off. Your financial autonomy doesn't depend on institutional permission. Some people find that liberating. Others find it frightening. But economically, it marks a shift in who holds power. Crypto exists because people want systems where they control their financial destiny, not where institutions control it for them. If financial autonomy interests you, or if it makes you uneasy, tell me why in the comments. People's experiences shape their views on crypto far more than the ideology. Bonus insight. Misconception? Crypto exists so people can make money. That's the story people see. It's not the story underneath. Speculation is loud, but it's not the purpose. It's the incentive mechanism that helped the networks grow. The economic purpose of crypto is deeper. It bypasses inflation. It reduces friction. It resists censorship. It decentralizes infrastructure. It distributes network ownership. It offers financial access where institutions fail. The speculation gets attention. The economics make it useful. Little known insight, crypto adoption is highest where systems fail. Crypto is loudest in wealthy countries, but most useful in unstable ones. In Nigeria, people use stable coins to escape currency controls. In Argentina, crypto offers refuge from inflation. In Turkey and Lebanon, people use it when banks restrict withdrawals. In Ukraine, it became a wartime payment rail. Crypto thrives not where institutions are strong, but where they are weak. The empowering truth. Crypto isn't a meme, it isn't a scam, it isn't magic internet money, and it isn't a rebellion against the financial system. Crypto is a mirror, a reflection of the pressures, failures, and imbalances within the existing financial world. It exists because the system needed money that can't be printed endlessly, systems that don't rely on institutional trust, infrastructure that no single entity can control, faster, cheaper, global movement of value, options for people living in unstable economies, escape valves when traditional finance fails. You don't have to invest in crypto. You don't have to love it, but understanding it helps you understand the world you live in, the forces shaping your financial future, and the direction money may be heading. And now that we've decoded crypto, which part of the money system should we decode next? Should we explore how banks actually create money, why inflation behaves the way it does, the rise of central bank digital currencies, the economics of stablecoins, or how financial crises spread beneath the surface? Tell me in the comments. Your vote shapes the next video. Stay smart, stay curious, play your own game. Let's decode the system.